Welcome to S&P Capital IQ's monthly loan market update. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, the loan market cooled in June as a result of negative investor sentiment and rising supply. Loans traded lower in June, handing the S&P LSTA Index its first loss since May 2012. The index was down 59 basis points during the month. Loans, in part, fell in sympathy with a broader retreat across the capital markets. As well, high-yield mutual fund managers sold loans to harvest cash in response to record outflows. Finally, as we'll discuss ahead, the loans market's own technical situation cooled in June. Before we get to loan conditions, here's a look at how loans performed in June relative to other asset classes amid the recent run-up in interest rates. As is usually the case, higher rates helped loans outperform. Loans, after all, offer investors a unique combination of short duration and relatively wide distributions that are particularly attractive in a rising rate environment. For this reason, inflows into the loan market rose in June. Loan mutual funds took in an estimated $6.8 billion based on data from Lipper FMI. As well, CLO issuance spiked to a three-month high of $7.3 billion from $5 billion in May. These figures pale beside the increase in supply in June. All told, the amount of S&P LSTA Index loans outstanding jumped $23 billion to a near-record $594 billion. The increase was powered by the $9.5 billion loan for Heinz, which funded in June. Given the technical and macro environment, new issue clearing yields jumped about 75 basis points in June to six-month highs. As July began, BB loans were printing in a 4% context, with single Bs in a 5.5% to 6.5% range. With loans printing at wider yields, repricing volume fell to just $7 billion in June from an average of $36 billion a month earlier in the year. Likewise, covenant-light loans lost a step in June as several issuers were forced to ante up a maintenance covenant to push their loans across the goal line. As a result, covenant-light loans accounted for just 27% of total institutional activity in June, a far cry from the commanding share they took earlier in the year. Turning to credit conditions, the default rate was effectively unchanged at 1.4% in June. Managers remain constructive on the near-term outlook. On average, they expect the rate to tick up to 1.8% or so by December, according to LCD's latest buy-side poll taken in mid-June. Participants expect the summer months to be slow, with arrangers focused mainly on placing M&A-related loans on the calendar. Opportunistic activity like recaps and refinancing, meanwhile, will likely be at low ebb until conditions improve. Still, demand for loans continues to run hot as retail and institutional investors look for ways to hedge against rising rates. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description. You can also download this presentation at slideshare.net.